Okay guys, in this video we'll talk about IFRS 16 and we'll talk about lessee accounting. And if you remember, we have already talked about the fact that IFRS 16 has actually two parts. One talks about the lessee accounting and the other talks about the lessor accounting. And we also said that for each of those parties, for the lessee as well as the lessor, there are two possible ways of treating in a lease transaction. One is that we can simply treat it as a rent expense for the lessee and as a rent income for the lessor, and alternatively we can think of it as a purchase on credit for the lessee and a sale on credit for the lessor, right? So today we are not going to talk about lessor, so just forget it right now, and only going to talk about the lessee. So this standard. Now we have to decide when to use what form of accounting. Should we use this as a rent expense, or should we use this as a purchase on credit? So the good news is for the lessee, it's pretty simple. You always have to use a purchase on credit. This is the right way of accounting for a lease transaction. But there are certain exceptions where you may choose to use the simpler version, and you may simply account for the lease transaction as a rent expense. And those exceptions are: if the lease is for less than 1 year, in that case you can account for it as a rent expense, or if the lease is for a low value asset. Now the standard does not set a criteria of what the low value really is, but we have to look at the asset in terms of the materiality of the individual entity. So it will depend. And okay, so let's talk about the real transaction, real accounting treatment for the lessee. So why are we calling it a purchase on credit? Like, it's slightly more tricky than that, right? For example, if a lessee has obtained an asset which has a useful life of 10 years, right? The asset has a useful life of 10 years, but the lessee has obtained it only for 5 years. 1, 2, 3, 4, 5. So, and for each of those 5 years, the lessee would be making a payment of $100 each year. And for the next 5 years, there would be no payment from the lessor. In fact, at the end of the 5 year, the lessee would return the asset to the lessor because it's only obtaining it for the 5 years. And that's what happens normally. So how can we account for it as a purchase? Because we are simply paying a rent, and that rent too is only for half the life of the asset. Why should we consider it as a purchase? So the IFRS 16 has come up with the concept of a right of use asset, and they're basically saying that we have the right to use that asset, and there is an asset in itself. So this is called a right of use asset. So at the start of the lease, this asset would be debited. By what amount we don't know yet. And what would be credited? Because we are not paying it on point zero, right? We are not paying the lessor anything on point zero. So which means the purchase is purely on credit. So what would be credit would be a liability. And in case of a lease transaction, this is called a lease liability. So okay, so we do not know how to come up with these values because we are not paying anything here, and this is not really a purchase. In fact, we are going to return the asset, but we are saying that because we are allowed to use that asset for 5 years, we may have some sort of a right of use asset. And because we have an asset, and we are not paying the payment right now, so we must be purchasing it on a liability, right? So how to compute these amounts? First, talk about a simpler one, and that is the lease liability. It's, it's simply the present value of all the lease payments. So let's say the interest rate implicit in the lease was 10%. Remember what we talked about in interest rate in the implicit in the lease? Interest rate implicit in the lease is the first choice to be used as a discount rate, right? So now I want to present value all of those $100 from the next 5 years to the point zero when we are actually recording this transaction. So we can simply do it one by one, and if you want to save time, we have a formula for it that is called the present value of one annuity, and it's simply P, which is the rentals, or R you can call it, multiply by 1 minus 1 plus I raised to the power minus n whole over I, and where P is the rental, and in this case is $100, 1 minus 1 plus I is 10% because it is the interest rate implicit in the lease, right? So we can simply write 1.1 raised to the power minus 5 divided by 0.1 because that is the interest rate implicit in the lease. So it gives us 379. So we now know that this is our lease liability. But how can we make sure that 379 is our lease liability? So let's make a payment schedule. Let's say at point 0, we owed a person $379. Right? So this is year. And the payment 2, 3, 4, 5. And the rental each year we are paying the lessor is $100, right? And out of this amount, what amount should be charged as an interest? We'll compute it. And what amount will be the principal repayment? For example, if I suppose that at point 0 my liability was $379 and I did not make any payment until 1 year, so what would be my interest expense for 1 year? That is simply 379 into 10% because that was the interest rate implicit in the lease, and that was the rate which we use to come up with the amount of the 379 to present value to all the lease payments, right? So this is the rate, 0.1. So 0.1 into 379 is 37.9, and which means that in the first year, if I paid $100 to the lessor, if the lessee paid $100 to the lessor, out of those 379 were interest, and if 37.9 were interest, and if 37.9 were interest, what would be the amount of the principal repaid to the lessor? That would be 100 minus 37.9, which is 62.1. Right? So what is the balance at the end of the first year? So the balance would be 379 minus 62.1. Why? Because the lessee owed the lessor 379 at point 0. Now at the end of the year 1, out of those 379, 62.1 have been repaid. The balance would be 379 minus 62.1, and that makes it 316.9. And now 316.9 is itself a balance now, and if the interest is charged on this amount for 1 year, that would be 31.7, and the amount repaid, the principal repaid would be 100 minus 31.7, which makes it 68.3. So the balance at the end of the second year would be 316.9 minus 68.3, which is 248.6, and so on. 248.6, the 10% rate would be 24.9. The principal repaid would be 75.1, and the balance would be 248.6 minus 75.1, that is 173.5. The interest charge on this amount for 1 year would be 17.35. Let's call it 30.3, which means the amount, the principal repaid on this $100 would be 100 minus 17.3. It would be 80.7. Sorry, 82.7. And if we deduct this amount from the previous balance, that makes it 90.8. 10% of this would be 99.1. And if the interest is 9.1, then the rental minus interest would be 90.1, 90.9. So if we deduct this from the balance would be 0. So we now know that if we assume that our loan was $379 and if we make $100 payment each year, then we would have basically prepaid all the principal by the installments, right? So that's clear now as to what the lease liability really is. Lease liability is simply the present value of all the lease payments. All lease payments can be present valued, and that's how the interest rate implicit in the lease works. It present values all the lease payments such that if we make the lease rentals, then it can be bifurcated into the interest expense and the principal, and both can be treated separately. But we are not going to talk about the subsequent treatment right now. We're just going to talk about the initial recognition. So at initial recognition, we have to create the lease liability and debit the right of use asset. Now at what amount do we have to debit the right of use asset? This is slightly tricky. Now if I had not made any payments or there are no other complexities, the right of use asset may be recorded at the same amount. So if the lease liability is really $379, the right of use asset may also be recorded on $379. But what if, imagine if on point 0 the lessee had made an additional payment to the lessor, which means in addition to the liability, the lessee had made a payment of $100. In that case, if because this payment also relates to purchase of that asset, therefore the asset would be 479 instead. So in fact IFRS 16 defines properly at what value do we have to record the right of use asset, and that is basically the right of use asset has to be recorded initially present value of lease liability and any lease payments made at or before the commencement date, which means advance payments, and any initial direct costs incurred by the lessee. Remember, the initial direct cost of the lessor was included in his investment, so therefore the initial direct cost of the should be included in his investment. Now, there's also a requirement in IS 37 that if we have a provision, if we expect that we would have to dismantle our asset, and that dismantling would require some amount of expense, then the provision should be made in advance. And when that provision is made, and provision is basically a liability of an uncertain timing and amount, right? So when that provision is made, the debit side of entry on would be made part of that asset. So if this is a right of use asset, then in that case too, the it should be added into the asset. So provision of dismantling costs. And that is it. We simply account for a initial recognition of a right of use asset as a debit of right of use asset and a credit of lease liability, or it might be a bank as well, or if there are other things like a dismantling cost. So that is how a lessee accounts for the initial recognition of right of use asset.